I look at the markets often, and I often ask myself, where are the contrary investors? I've seen in the past a lot of situations over the years where contrarians are always the ones that make the most money. And why is that? It's because the crowd is often wrong. That's what I wanted to share with you on today's show. I'm Alan Barry Labucan from AlanBarryReports.com. And I wanted to go a little bit into some of the things that I'm seeing as a contrarian in the market these days. One of those things that I often notice is I'm always looking for when emotions take over the market. That's where you find the real contrarian plays. And right now I'm seeing a lot of contrary plays. I do a show that I talk, it's called The Stock Ticker. I do it on 1938news.com. And for about the last 8 weeks, I've been talking about how I've seen that the market was getting toppy. It went from toppy, it got right up to overbought, and in fact, even what I would call priced for perfection. And I was talking a lot about how I thought it was time for investors to be taking profits, looking at things like those ETFs that are 3 times bear ETFs. So when the market goes down 1%, they go up 3%. Market goes down 5%, they go up 15%. I think that those are the best ways to beat the market and get some really good performance. And I really think that there's a lot of opportunities out there to beat the market. But the trick is you have to go against the crowd. When the market was getting what I considered, when the S&P 500, the Dow Jones Industrial Average, the NASDAQ market, were all getting up to what I called price for perfection, everybody was getting very bullish. Everyone was talking about how the markets were going here, and the Federal Reserve was accommodative, and they were helping pump liquidity into the market, and the markets couldn't stop going higher. Now, prior to that, for about a year and a half prior to that, on all of my shows, I was extremely bullish. So what was the difference that happened in the last 8 to 10 weeks? The difference was when I got really bullish on the market back in the fall of 2012. The reason that I was so the fall of 2011 and throughout all of 2012 and part of 2013 as well, was because the market at that time, if you looked at the averages, they were trading at like 13 times earnings. And on a historical level, that's very reasonably priced. That's why I had gotten very bullish. I also saw that there was, while a lot of people were calling it the jobless recovery and really jawboning and talking down the market, it kept on going up. Then the market got to a level where I saw it getting toppy when it was trading at more than 15 times earnings. Right now it's trading at about 16 times earnings. But the problem is that a lot of companies on the S&P 500 and the Dow kind of stocks are only growing their earnings at maybe high single digits to low double digits. And when you get that kind of premium in the market for that kind of, not spectacular earnings growth, that's when you get to a situation like we're priced for perfection, which is where we've been for probably for the last 4 weeks or so, when the Dow was over 15,000 and NASDAQ was up quite high as well. They both move in a relative basis, so you can use the price around 15,000 on the Dow and then go see the corresponding price on the S&P 500. And when they got to that kind of evaluation, it was really priced for perfection. But then the crowd started getting much more bullish. The talking heads, I started noticing that while the market was going up for all of 2012, they were talking down the market. They called it the most unloved bull market ever and stuff like that. But then I noticed that they started to get really bullish, and when they started getting really bullish, I started to get very worried. And that is in itself sort of an indication of what it means to be a contrarian. While everybody was sort of lackadaisical or bearish on the market and it was going up, that was a good time because the fundamentals were there on your side as well. You can't just go against the crowd because, let's say, the stocks have gone up a lot or down a lot. You'd go the opposite direction. There may be fundamental reasons why those things are happening, and that's what you have to look for. You have to look for when the crowd is wrong and the fundamentals are in your favor to go the opposite direction. So that's why for the last 8 weeks or so, I had been progressively getting more and more bearish on the stock market. I started talking more about investors. It's a great time to take profits, build up cash, and get ready for a correction by building up that cash and also looking at these ETFs that short the market, like the one that I follow is FAZ for my friends in America. That was the one that I followed. They're pretty generic, so you can look at almost any of them, and they'll give you the same kind of performance. And so that was another way that I thought was a great way for investors to play the correction. Now, in the last couple days, we've finally started to have what I think is the start of a correction. We've had a couple of fits and starts in the last 4 or 5 weeks. We've had a couple of 3 to 4, 5% pullbacks, and then it gains back up. I think that things are a little bit different this time. This time, the pullback, like for today, 350 points, was much more significant in one day. I think we have some more follow-through before we get any kind of a short-term rally. When I'm talking about a rally, I'm talking about day trading type rallies. But what scared the market today, and I believe that this is just really an excuse for the investing community to start getting more bearish on the short-term market trend, was the Federal Reserve came out a couple days ago and talked about that they may start tapering in their quantitative easing. Translation is that since the economic collapse in 2008, the Federal Reserve has been going in there and pumping money into the system, mainly to bail out the banks. It's been manipulating the interest rate curve on the short and long-term curve, and they print money on a constant basis to buy all these bonds, and it gets money into the system. But what I find just incredible is the idea that they can stop doing the manipulating that they're doing. They have become about 70% or more of the market. So the only way, and you can record this and you can replay this every time there's a Federal Reserve meeting and they talk about what they might do or what they could do, and there's all this nonsense going on the talking heads on TV. Here's the bottom line. When there is somebody who is bigger that is able to take out the Federal Reserve's position in the bond market, that's when they'll start getting out of the bond market. They can't stop manipulating the market, because if they do, there's no one there else to buy the bonds. They are the market. So the idea that they're going to taper or start reducing how much their portfolio of bonds is absolutely ridiculous. They like to talk a lot. They like to make a lot of noise. The reason that they like to do that is because they get themselves in front of cameras. The Federal Reserve is no different than politicians. They all like to get themselves in front of cameras and I know the answer to this and blah, blah, blah. Well, Mr. Bernanke and the Federal Reserve are not that brilliant as the market gives them credit for. They have a printing press that enables them to be able to buy as much bonds as they want. They've been manipulating the curve, and now they are the market. There's nobody out there that's going to replace that. So the idea that they can stop doing that is absolutely ridiculous, and it isn't going to happen. The reality is that they really can't exit until somebody else comes in, and right now nobody's interested in buying bonds when you get such a low rate yield out of them. I mean, why would you want to buy bonds when you're losing purchasing power on a daily basis relative to inflation? It just makes no sense. They will continue to manipulate the market. They will continue to be in there, but my biggest problem with what the Federal Reserve and all the credit that people in the market try to give them for, they say, well, they stopped another Great Depression from happening. No, what they stopped is they stopped the banks from going in bankrupt. Now, if you gave me $85 million or $85 billion a month and let me rack up trillions of dollars in expenditures, I could have turned the economy around a hell of a lot faster. It's not any mystery why when the Great Depression happened, why it turned around. The federal government started spending money on building roads and infrastructure throughout the country. That great buildup of America is what pulled the economy out of the Great Recession, the Great Depression. Now, what we've went through in 2008, we could have at a way less expenditures than what the Fed did. The roads are getting old and tired and needing to be repaired. The power grid needs to be repaired. There's all kinds of infrastructure that needs to be repaired. Had they have put the money into that instead, the economy by now would be a hell of a lot stronger. The government numbers on the employment rate are kind of ridiculous. The reality, they talk about 7.22 unemployment. The reality is, if you took into consideration all the underemployed people, the people that are not working at the jobs that they were trained for, the people that have left the employment market, there's a reason why there's no employment, there's no pressure on wages right now that would really push up inflation even more, and that's because there is a weak labor market. It's not as strong as those government numbers are indicating. And so the idea that Fed Chairman Bernanke did such a phenomenal job is ridiculous, but the market still, I can't believe how much credit they give him to move the market. It's absolutely ridiculous in my opinion, but that's the market we're in. And here brings up another, when the Fed Chairman Bernanke came out and said that they're talking about slowing down their purchases and tapering off their $85 billion worth of bond buying per month, what does everybody do? They jump on the US dollar. Now, that is one of the most craziest safe haven plays I've ever heard of. You look at the currency is kind of like the stock certificate of the country. So you got to look at the balance sheet of a country to sort of get an idea of what the stock certificate of the country should be trading at. And when you look at that, they're printing money like it's going out of style, running up annual deficits of over $1 trillion. I think we're going on 5 to 6 years now. The deficit is growing, or the debt is growing up to, it's within striking distance of $20 trillion now. To jump on the US dollar as a safe haven bet is just ridiculous. And what happens when everybody jumps on the US dollar? The commodity prices get hammered. Now, if you understand anything about commodities, whether it's gold, which got hammered by $92 today an ounce, silver got hammered by close to $2 an ounce, copper got hit, oil got hammered by $2, $3 a barrel. The reality is, for all of those commodities is that, and most commodities is that, these companies that are involved with producing those commodities are going deeper into the ground for lower grades, into more difficult jurisdictions to operate, and the supply chain is getting weaker and weaker and weaker. Now, when you have a commodity, and the US dollar is a commodity, I hate to tell everybody, and in the case of the US dollar, you have ample supply and I would say questionable demand. On the other hand, with commodities, you've got shrinking supply and difficult replace that supply, and yet you've got demand from all over the world. Now, even if that demand slows down, if it slows down at the same rate that the supply chain slows down or weakens, well, you still got a pretty bullish situation because the supply chain has been under looked after for a long time. So, there's another situation where I see a very emotionally trading market right now. Is you look at gold stocks, whether you're looking at the biggest gold stocks like a Goldcorp, or the biggest silver stocks, like big silver stocks like a Pan American Silver, or big copper stocks and other commodities like a BHP or a Teck Resources. The reality is that they're trading at very low values right now because of what's been happening in the commodity prices. And what's happening in the commodity prices is the paper market, bond or options and ETFs and futures trades. Those paper type transactions are controlling the price of those commodities. But the supply-demand story on the physical side is much more bullish. So there's an emotional trade. There's some of the emotional trades that I see. First of all, the Federal Reserve on interest rates. If the Federal Reserve wasn't the whole market and could manipulate the market as long as they wanted, I'd say short the bonds, because they're extremely overpriced. They're at all-time record highs over the last 50 years or so. They're not something you want to buy right now. They're something you want to short, but you can't short it because the Fed can continue to manipulate the interest rates as long as they want. Got to be careful with that. The US dollar, I don't think you really need to short the US dollar because you've got a problem there too. You've got all these other currencies in the world where, they're just as goofy as the government in the United States and in their ways of spending money. So that's a risky trade, but a better way to play it, I think, is to play the commodities. Looking at things like a Goldcorp, a Pan American Silver, BHP and Teck Resources for their copper and other commodities that they produce, I think that you're going to see those pop in the short term. I also think that any kind of pops in the stock market, you want to use those to add to things like the ETF that shorts the market, because I think that this market is trading at about 15% from the high, about 15% above where it should be. Now, whenever markets correct, they tend to overdo it on either direction. They either overdo it on the way up and they overdo it on the way down. So although I think the market is 15% overpriced, I think it could correct by 20% before it's all said and done. There's a reason why being a contrarian has always been the way that people make big money in the stock market. It's because in the stock market, you have to go against the crowd. When everybody is doing one thing, you have to look for situations where the fundamentals are in your favor and you can find contrary plays that are going to benefit from that emotional type action that's happening in the market. Even today, after the market, yesterday it was down a couple hundred points. Today it's down 352 points on the Dow, and the NASDAQ, or S&P 500 and NASDAQ are about down the equivalent same amount. The talking heads on TV are still talking about buying the dips. So that tells me that this short-term correction, I think there will be a bounce once things don't go in either direction, straight up or straight down. there will be a bounce, and then I think more downward action and to this downtrend that I'm seeing happening. But I still think we're a couple days away from a short-term rally inside of a correction that I see happening. And so I think you could stay short with that FAZ and things like that. I think you want to continue, you get any rallies, continue to build up cash, because when the market overreacts on the downside, and mark my words, it will, and you'll hear these talking heads, when the Dow Jones and the S&P 500 get down about 10% or more, they're all going to be talking about doom and gloom. When they get to the doom and gloom phase, that's when you want to start going the more bullish direction. Right now, I think there's way too much bullish optimism out there on the overall stock market. I also think that there's over bullishness on the US dollar, which has pushed the price of commodities like gold, silver, copper, oil, other commodities down quite dramatically. And I think that they are dramatically oversold right now, and I'm looking for to be bullish on the commodities and continue to be bearish on the overall stock market. So those are the way contrarian like me sees things these days, and I just wanted to put this video together to let you know, let the audience know what I'm seeing. Next week I'm going to try and do a couple shows, because I've got a couple things that I see happening in the market right now that I really want to talk about next week. When it comes to resource and mining kind of stocks, I'm seeing some trends in there that, again, this is a market where the emotions are just beyond realistic in their bearishness. And I think that there's some ways that that investors can make a lot of money by playing that kind of a trade. But I want it, because today we saw the Dow down, we saw gold down dramatically, silver, copper, oil, the US dollar up. I wanted to put this together because I think that there's some real short-term trading opportunities, and I wanted to put, get some clarity on some of the things that I think investors can make a lot of money on in the short term right now, because there's some real serious inefficiencies in the market. And at the end of the day, that's what contrarians are looking for. There's not a lot of contrarians out there, even though a lot of people think they're contrarians. They're looking for inefficiencies. I've talked to you today about some of those inefficiencies, and why you want to look for those inefficiencies is because that's where you can maximize how much money you can make in the markets. And that's been the way it has been over time and will continue to be into the future. That's a wrap on today's show. I'm Alan Barry Laboucan from AlanBarryReports.com. Have a great day.